We've also got this virus and these cases that are exploding to deal with, too. So what does it mean to you? What do you do?
Well, these two headlines have been there for a while now, Scott. It seems like every day we come in and those are the two topics, right? We're looking at the vaccine and the possibility of how that's getting rolled out and how that's affecting those with the virus and so forth. But also, we've been waiting on this. Think how long we've been waiting on this stimulus package, and they've been negotiating back and forth, and it feels like it's been forever. And I think when we start to see some of those positives, I think the markets are going to react. Obviously, yesterday, the reaction was to look back over and be more concerned about what was going on with the virus itself. So I think the opportunities are out there, Scott. I like the names that have been working of late, biotech being one of those, semiconductors being another one. So I think there's a lot of different areas, materials as well. There are parts of the market that I think have been working. I think they'll continue to work. And obviously, depending on the news itself, that's going to play out for what other areas of the marketplace are going to be able to react. But I think right now you can stick with those areas, including energy, to the upside.
Well, Tiff, you know, one of the central questions in the way we lead the show off today is whether you go back to what worked before. And that's really what Cramer has given us from last night's Mad Money, which I wanted to kick out today with all of you because I think it's an interesting way to sort of discuss where we are. By the way, congratulations on your new firm. That's big news for you.
Thank you so much.
And I know you're so thrilled about that. We are for you as well. So Jim Cramer said the following on Mad Money, okay? Quote, the recovery stocks are handing the baton back to the lockdown winners because lockdown is where we're headed. The market's saying the good news on the vaccine is baked in, so it's time to focus on the bad news of the totally out of control pandemic. After weeks of focusing on the vaccine, the good news is old news. Now the outbreak is front and center. So what do we do with that?
Yeah, so, you know, again, I love Jim, but I respectfully disagree. You know, I think that we have a really interesting situation where we have a ton of data. If this was any other year, we'd be sitting here, you know, just a few short you know, days before Christmas trying to, you know, predict what's going to happen in the markets. But now we know we were in a global pandemic. We're coming out of that. We have a vaccine that's going to be in full distribution within, you know, six-ish months. And so we have these data points that we can use and leverage. I don't believe there's this kind of, you know, swinging back from, you know, open stocks to stay-at-home stocks. We're looking for opportunities. We're looking for companies that were able to, you know, kind of weather the storm and that we think will continue to do well. We're not kind of going back and forth between that stay-at-home open trade.
Okay, so you use the analogy of, you know, the storms. And that's kind of where I wanted to go, Josh, because I feel like, okay, the eye of the storm has passed over us in the spring, but the backside of this Category 5 has a lot of strength to it, and it's going to do a lot of damage to a lot of people between now and when we can all have access to the vaccine. What does that mean to the stock market then?
I think Tiffany made the right point, which is that nobody should really be doing this like every week, like, oh, it's a vaccine week. Oh, no, it's a work from anywhere week. Like, I think that's bad investing. I can't imagine it leading to a P&L that, like, makes anybody smile. So I think the approach of looking for good businesses that are going to weather this and in some cases are discounted because of this and in other cases are seeing an acceleration in their business as a result of this, like, look for those types of situations and just be an investor. I don't think you know from week to week what's going to outweigh what in the mind of the public consciousness, and therefore which stocks are going to go up or down. I think it's like not a great game for people to be playing. But
if you look at, you know, the so-called stay-at-home trade, Josh, the Zooms and the CrowdStrikes, which, you know, you're in some of these names, and you have added to them along the way. The DocuSigns, Okta, Shopify, these are the ones that I'm talking about as it relates to what Cramer's talking about. PayPal, Peloton, Netflix, Teladoc, Amazon, Adobe, Twilio.
Yeah, I'm not in almost any of those stocks. And I definitely have not been adding to Peloton. I'm not in those stocks. Let me tell you what I'm seeing. The market is super healthy overall. We talked last week about Ralph Acampora saying, you know, rotation is the lifeblood of a bull market. We're still in that scenario, and what we're seeing now is some really interesting dispersion between stocks that prior to the last couple of weeks, Judge, were trading in lockstep. And dispersion is healthy. So look, Apple's moving higher, but Facebook's moving lower. Microsoft and Amazon are sideways. That's great to see. They're not doing the same thing each day, up, down. Now look today, airlines down, cruises crushed, but casinos up. So that in-out nonsense is not actually working anyway. Peloton looks great. Zoom is stalling out. Those stocks were trading in lockstep when we were having those vaccine on, vaccine off days. And now that's not happening. Square and PayPal are near all-time highs. But then look at the banks. They're giving nothing back. They're consolidating their gains. The regionals look good. Large cap looks good. Wells Fargo, Goldman Sachs. So why are PayPal and Wells Fargo both working at the same time? Because those correlations are breaking and dispersion is starting to happen. And that's what you want to see. You don't want to see red team, blue team. That's nonsensical, and it never lasts. And just think back. We were doing this show in 2011 when Gartman was launching on-off ETFs. We laughed at it then. It's still stupid 9 years later.